And the next one is from Buttersbot 2. It says, and okay, we haven't got this topic in a while. So I was like, we're doing it. It says, when does it make sense to refinance a mortgage? Oh. How much should the mortgage drop before it is worth the costs? Can you refinance too much?
I love this question.
Right? And like we haven't seen it, so it's just sort of like, whoa.
Because we haven't had to talk about it in forever,
like
right?
There's some possibility that things are coming down or changing.
So here's what's great. So I'm going to do just a quick, right? What is refinancing a mortgage? Because we have a lot of first-time home buyers in here.
Yeah.
Who've bought their house and they got like a 7%, 6.5%. What are Daniel? 6.5%,
right
7.5%, something like that on the 30 year.
He's saying yes.
And like they bought their first house. Well, one of the things that happens, and we haven't seen this in like a decade, maybe even more, maybe almost 15 years, because rates have been so low, there hasn't really been an opportunity to refinance for new home buyers because the first mortgage they got was super low. Well, now first-time home buyers or home buyers in general are locking in these high rates. Well, one of the things you can do if you have a mortgage and rates fall, you can go to your lender or you can go to another lender and say, hey, I owe $100,000 at 7%, but rates are now 5%. I would like to refinance this mortgage and I want to hold it at 5% with you. So will you give me $100,000? I'm going to pay off this 7% and I'm going to borrow this from you for 5%. Well, lenders are willing to do this because they want the debt. Like they are willing to like refinance so that they can now hold your debt. And it's a beautiful thing. Well, the question is, okay, when does it make sense to do that? It literally all comes down to math. It all comes down to math. And here's the way you do the math. First, you open up a spreadsheet or you Google amortization, mortgage calculator, mortgage, whatever. You got to do a spreadsheet. What you want to figure out is if I were to refinance, how much interest savings will I have? Now, this is key. Pay attention here. Paying the mortgage on the same timeline. So if I was in a 30-year mortgage and I've been in it for 5 years and I have 25 years left on my mortgage and I go to refinance, the mortgage company is going to give you a 30-year mortgage. What I don't want you to do is to pay that out over the 30 years. I want you to recalculate your payment to pay it off over 25. So now you're comparing apples to apples. If my mortgage payment was $1,700 a month on my original mortgage, and now I refinance and pay the same payment or pay it on the same schedule, what will my new payment be? And let's say that new payment's $1,500, right? I have $200, and if it's on the same timeline, that is exactly interest savings. So now I say, okay, if I have $200 of interest savings every month, how long does it take me to recoup the cost of the refinance? Because when you refinance, it's going to cost money. So let's say that it was 1% of the outstanding mortgage balance. I'm just making stuff up. So if it's a $100,000 mortgage, it's going to be $10,000 of refinance costs. It's good math. Is that right? No, $1,000.
Nope, yeah.
$1,000 of refinance costs.
Again, not good with the zeros.
Not good with the zeros. How many months of interest savings will it take me to recoup the cost? So what you're going to find is, okay, for a lot of them, it might be, hey, I have to be in this house for 3, 4, 5 years in order for the interest savings to compensate me for what it cost me to refinance. Well, if you believe you're going to be in the house for at least that long, then you do it. It makes sense. If you think there's a chance that you're not going to be in the house, like maybe the break even is 10 months or 10 years or 12 years from now, and there's a good chance you're not going to be in there, then you might not want to refinance. So obviously the thing that has the biggest impact on this is the spread between your current mortgage rate and the new mortgage rate. It doesn't make sense to refinance from 7.5 to 7 3/8, right? Like that doesn't benefit you a ton. To go from 7.5 to 6.5, now you're going to have some material savings that you'll be able to calculate through time. All right. Did all that make sense?
Honestly, yes.
Okay.
Good explanation.
One more thing I'm going to say to you. We haven't gotten there yet, but when we get there, refinances cost money. And oftentimes when you refinance, your current lender may or may not be willing to refinance. You might have to go to another lender. One of the tactics you can use is you can go to your current lender and say, hey, rates have fallen. I would like a rate modification. A rate modification means they'll leave your exact same loan in place and they will literally modify your rate down. It's not a new loan. It's not a new mortgage. It's not a new lender. They'll say, hey, we're going to charge you $400 to modify your loan. Not all lenders will do this, but this is what you say to them. You say, hey, Mr. Lender, I love you. You're so good. Your portal's great. I want you to have my business for the next 30 years. But if you don't modify my loan, I'm going to take it to Miss Lender across the street and she's going to give me a new mortgage. So rather than losing my business altogether, will you give me a rate modification? Second best answer you can get is no. So ask. If they say no, then you can proceed with the refinance elsewhere. If they say yes, you just saved yourself a whole lot of headache, whole lot of time, whole lot of money, and it can be effective as of the next payment cycle. It's really, really fun. We will start, if rates come down, we'll start seeing more of this stuff. This will become more and more and more commonplace.